The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of FedLife Podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager at Serving Those Who Serve at Lee Sipe and Associates. I'm going to begin as I always do for everything, this, the webinars, you name it. I always begin by saying thank you. Number one, thank you for taking the time to listen to us or to watch. But above all, thank you for your service to the government, to the country, to me, to everyone. You absolutely do not hear that enough, but you will always hear it here. And the other person that you always hear with me on the Fed Zone is the guru, Ed Zerndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Once again, we are following Ed's Fed Zone articles. If you are not familiar, check out fed-zone.com. You will see a cornucopia, just coming off of Thanksgiving, of articles covering just about every topic under the sun. They're searchable. You can find them. So this whole thing with tying it together with the podcast is just one more way that we can reach and teach. So Ed, we're not supposed to break the walls of time and space with podcasts, but we are indeed wrapping up another year together and covering a couple of odds and ends here, and specifically your thoughts on the benefits of HSAs, health savings accounts, but also you have some cautions and warnings for people. So for the uninitiated, what is an HSA?
Okay, Dan, let me start this way. That there is no health insurance plan, there is no dental insurance plan, there's no vision insurance plan out there that pays for everything. There are out-of-pocket costs, there are deductibles, there's co-insurance, there's co-payments, there is certain expenses that your insurance will not pay for. So the question is, if someone has these insurances, how do they pay for these out-of-pocket expenses? What is the best way to pay? Most people pay it with after-tax dollars. Now, ideally, you'll pay these expenses with pre-tax dollars. And there are certain types of accounts out there that federal employees can utilize in order to pay for out-of-pocket medical, dental, and expenses, one of which is called a healthcare flexible spending account, HCFSA, in which only employees, but not retirees, can set aside part of their gross salary before all taxes put into this account to be reimbursed for out-of-pocket expenses. That's one way. The other way that's available to federal employees and retirees is something called a health savings account, an HSA. Now, withdrawals from HSA can be used to pay for out-of-pocket medical, dental, vision expenses, both when you're an employee and when you are a retiree. There's one of the downsides for the healthcare FSA, actually two downsides. One is that you set aside the money from your salary, you got to use it up for that year. If you cannot carry over money from one year to the next, one calendar year to the next. Also, when you retire, you cannot use a healthcare FSA. But with an HSA, both of these things is not the case. You can carry over money in your HSA from one year to the next, and you retire or leave federal service, that HSA, it's like an IRA. You're saving, putting money in the IRA, and you save, you put money into the IRA contributions while you're an employee, federal employee, or any type of employee, and then you take the money out when you are in, after 59 and a half. But it's yours. It's yours to keep. It's yours to keep. It's yours to keep to be used. Now there are certain requirements in order to contribute to an HSA. If you are a federal employee and you're interested in contributing to an HSA, you have to enroll what's called a high deductible health insurance plan, HDHP, a high deductible health plan, HDHP. And the Federal Employees Health Benefits Program offers several high deductible health insurance plans. When you enroll in a high deductible health insurance plan, you will have access to an HSA in which you can make contributions to your HSA and to be used, and then you can make withdrawals from your HSA to pay for qualified medical, dental, vision expenses. But there are some differences between the HSA and the healthcare flexible spending account. I always say that the HSA is in reality, it's like an IRA in several ways, but it combines the features of both a traditional IRA and a Roth IRA, in many ways. So
Gotcha.
That's the background information regarding, and we're going to talk about those tax benefits here in a few moments. There's really what I call a trifecta tax. The HSA offers a trifecta tax advantage through it, the way it works.
Gotcha. And so I think you gave a pretty good framework for how this all fits in within FEHB. So let's go ahead. Let's talk about that trifecta, because I love this part of it. So
and this is the good part here.
Absolutely.
Now, let me just mention something about this high deductible health insurance plan. The IRS every year sets the limits as far as what is high deductible. What do you consider to be a high deductible health insurance plan? Well, in 2024, I think I have the limits here. Let's see. If in 2024, if you have self-only coverage, the minimum deductible is $1,500. If you have self plus one, self and family coverage, the minimum deductible is $3,000. For 2025, it goes up $1,650 for self only, $3,300 for self plus one and self and family. And everybody's like, my God, that's a big that's a large deductible. I don't know if I want to pay that much out of pocket before I'm going to start having coverage. Well, I have to say that under the rules for the high deductible health insurance plans, you don't have to reach the deductible before your plan starts paying for certain items. This is called first dollar coverage. What does that include? First dollar coverage includes well visits. You have your annual well visits for yourself, for your members of your family, for certain procedures like colonoscopies, mammograms that the women get. They're covered first dollar. You don't have to reach that deductible. Well, I want to make one comment then. It's been my observation over the last few years, Dan, that deductibles are going up in general, all plans. I can remember the days, it shows my age, where a deductible for self-only may have been like $100.
Sure.
Family, $200. Now I see deductibles $500 to $1,000 for self-only. Plans. These are not high deductible plans. They are like fee-for-service preferred provider plans. And for family, $1,000 to $2,000. So that $1,500, $1,650, $3,350 is not that extreme. Also keep in mind that if you enrolled in a high deductible insurance plan, all FEHB high deductible plans have catastrophic limits, the most you're going to pay out of pocket. It's like $6,000, which isn't that much, $6,000 for most of these plans. So that is something that has to be considered. And then your plan, you can go to, if you go to, you are in a preferred provider plan, you stay network, your plan will pay for most of the costs once you reach that deductible. So it's not as bad as you may think. Now let's talk about the tax benefits. All contributions that a HSA owner makes to his or her HSA is fully deductible. It's fully deductible. That's the first tax benefit. Okay. The second benefit is that the HSA accrues earnings. You can invest it like an IRA. I know, Dan, you are associated with a brokerage, Raymond James.
We are indeed.
Do people come in to say, I'd like to invest my HSA? Like they like to invest it?
We give guidance to all of our clients on that for wherever the plans are set up to be able to do that. Yes, 100%.
So they are available. Brokerages do have these, okay. All right. So these earnings accrue earning. The money in the HSA accrues earnings. Tax free. Why? Because when qualified withdrawals are made from the HSA, what are qualified withdrawals? To pay for out-of-pocket medical, dental, vision expenses, then the withdrawals are tax-free. That includes the contributions that the HSA owner made, earnings, the earnings that are accruing are all taken out tax-free. Tax-free. Okay? Talking about qualified withdrawals, I mentioned a few moments ago that the HSA can be taken in retirement, can be used in retirement to pay for out-of-pocket medical, dental, vision expenses in retirement. We've talked many times about Medicare Part B. Medicare Part B, there's a monthly premium. You have to pay a monthly premium for Medicare Part B. The higher your income, the more you got to pay for Medicare Part B. You can request from the HSA custodian to be reimbursed for your Medicare Part B premiums. You can get reimbursed for that. This is after you have retired. You can also, if you're an employee or retiree and you're paying long-term care insurance premiums, guess what? You can get reimbursed for the long-term care insurance premiums. Long-term care insurance, the premiums are not cheap. And you can make withdrawals from your HSA to be reimbursed. This is great. So the HSA offers this called trifecta tax advantage.
Sure. And Ed, I know you feel as we do that a properly funded and managed HSA can be a component of a great retirement picture. Because I don't know about you, Ed, I don't know about our listeners, but speaking for myself, I'm seeing the doctor more now than I did in my 30s. And so I have a bunch of medical expenses that I didn't have 30 years ago. And so having tax-free funds available for that, really attractive. And as you mentioned in your article, this is kind of a super retirement vehicle in the fact that it goes in pre-tax, gross tax deferred, comes out tax-free. To my knowledge, it's the only place in the economy that it does that.
And these HSAs, Dan, have gotten much more attractive since they've been around. They started back in 2003, and they've gotten much more attractive now than ever. And it goes back to what I said a few moments ago. People get scared about the high deductible, about the amount of the high deductible. But all deductibles are going up. There's not that much difference between what the IRS considers high deductible for a high deductible health insurance plan and what you have with a PPO plan. There's not that much difference. You might as well get those tax savings and then enroll in it. But of course, if you go to the doctor a lot, let's say you have a family, it's like that, you're going to be using up the funds in the HSA. I mean, ideally, someone would enroll in a high deductible health insurance plan at a time that they're not incurring a lot of medical expenses.
Sure.
In order to keep the money in that account. So later on, and they were, let's say later, when they're later in their career, where they're going to the doctor more, they're retired, they're going to the doctor more, and they're going to be enrolled in Medicare, they'll have the money there in the account. Because again, it's like an IRA. You take the money out, you can use it to pay for those medical expenses.
Absolutely. And as with anything else that's really, really good, there are also rules and guidelines we got to follow so we don't trip ourselves up. So you wrap up your article with 4 common mistakes that our feds should avoid. So why don't you wrap us up and take us through those?
Okay. When you make a withdrawal from an HSA and you use those withdrawals to pay for expenses that do not fit the IRS definition of qualified medical expenses, then you're going to pay a penalty. And the penalty is you pay the tax on the money coming out, federal and state income taxes, and a 20% early withdrawal penalty. You got to be careful about that. Now, let me just mention this, and this is important, that when you have an HSA, you have associated with your HSA a custodian. It's like an IRA custodian. And through the years, you're funding this HSA, but when you take money out of it, when you're requesting from your HSA custodian that you want to take a certain amount of money out of the HSA,
sure,
okay, the custodian is not going to say, well, now what is this for? Is it for qualified medical expenses? That is the case, by the way, Dan, when it comes to a healthcare FSA. The healthcare FSAs have a custodian, and you cannot take money. You're not going to get the money unless the custodian says, yeah, this is for a qualified medical, dental, or vision expense. Not the case with the HSA custodian. So what's going to happen is that, let's say somebody has an HSA and they want $2,000 taken out of their HSA. During the year, they had $2,000 taken out. They got the money, spent it any way they wanted, and they're going to get from the HSA custodian, guess what? A 1099.
Sure.
A 1099 SA. Now, what is that for? For informational purposes. Does the IRS get a copy of it? Sure they do. So the person says, well, I took the money out. Who's going to know? Well, the IRS will know. So what? Well, in case of audit, you get an audit. And the IRS revenue agent says, I notice here there's a $2,000, you took out $2,000 from your HSA. Yeah. What did you use it for? Do you have records? Because if you don't have records, if you spent that $2,000 on, use it as a down payment for your car, and okay, IRS says, again, I want to see the records. What did you spend for it? Give me your credit card statements, anything that you use this money, to reimburse for withdrawals. I want records. I want to get proof that you use it for qualified medical expenses. And you say, I don't have it. Guess what? Penalty. You pay full tax, $2,000 full tax, and a 20% withdrawal penalty. A penalty. Ouch. That's 20%.
Ouch. Double ouch.
Say they're in a 24% tax bracket, federal. That's $480. That's $480 of federal income tax, 8% state. Let's say another $160 plus another $400 penalty.
Ugh.
You don't want to do that, so you have to keep records. You have to keep records. Okay.
Gotcha.
Now, we're one exception to that penalty. That if you're over 65, here, let's say you are a federal retiree and you have a lot of money in your HSA and you want to take the money out to pay for something else, other than net conferences, you have to pay federal and state income tax, but no penalty because you're over 65. All right.
Gotcha.
Now, here's another problem. Number 2, the tax impact resulting from naming a non-spouse as an HSA beneficiary. When you set up your HSA, you should, like you said, when you set up your IRA, you name a beneficiary. Anybody can be named as beneficiary of your IRA. Anybody can be named as beneficiary of your HSA. But there are some important differences. That the HSA owner dies, there's money in their HSA. If they've named their spouse as the beneficiary, then the spouse can use money in that HSA to pay for qualified medical, dental, vision expenses. Again, no taxes are due. Okay? They're not required to withdraw everything in it within 1 year of the death of the HSA owner, which is the case with a non-spouse beneficiary. If you name, let's say, your adult child or your sibling, brother or sister as the beneficiary and you die, then your non-spousal beneficiary has to withdraw everything that's in the HSA within 1 year. Within 1 year, pay federal and state taxes, but no penalty. Now, is that the case, by the way, with an IRA? Let's say you know a non-spouse is a beneficiary of your traditional IRA.
Right.
What does the non-spouse beneficiary have to do with the IRA?
Current rules, they got to get it out in 10 years.
10 years.
Yep.
That's a big difference. And they don't have to take out a little bit each year. They can wait to the end of the 10 years. Here, with the HSA, they got to take it all out within 1 year. Okay? So that may be the downside. Okay?
Got it.
Number 3, we've talked about this, and I think I wrote a separate FedZone column about this.
I believe you're
Another
right.
question area is Medicare enrollment.
Yep.
Once you enroll in Medicare, most people do at age 65, Medicare Part A. At that point, you can no longer contribute to your HSA. I repeat, contribute. You still can use your HSA. You still can use it, make withdrawals. You just can't put any more money into it. So I've gotten this question from federal employees. Ed, I have an HSA. I love my HSA. I love putting money into it. I'm turning 65 next year. I had a question. Somebody's turning 65 in June. What do I do? Should I enroll in Medicare Part A? I said, do you plan to keep working? You plan to keep working federal service? Yeah. This way I can keep funding my HSA. I said, don't enroll in Medicare. Don't enroll in Medicare. I thought I had to. No, you don't. No, you don't. Now, Medicare Part B, if you don't enroll when you're 65, in order to enroll in Medicare Part B, you got to be enrolled in Medicare Part A. But when you enroll in Medicare Part B, there is a monthly premium. But the rule is that if you are in federal service at age 65 and you can plan to continue in federal service past age 65, you are not required to sign up for Medicare Part B until you retire. You have what's called a special enrollment period when you were retired to sign up for Part B. This way, you can delay your Medicare enrollment and continue to fund your HSA. The minute you put money into, the minute that you sign up for Medicare Part A, no more contributions can be made to your HSA. So you should delay.
Gotcha.
In fact, I recommend that when somebody's turning 65, and they are retired from federal service, they have an HSA, they should stop making HSA contributions at least 1 month before the month they turn 65. They should stop. There is an IRS penalty if you contribute to your HSA and you are enrolled in Medicare. You have to, what happens is if you contribute to your HSA and you're enrolled in Medicare Part A, the penalty is those contributions you made to your HSA, IRS is going to tax them. You thought you got a tax deduction, you're not getting a tax deduction. On the other end, you're being taxed on your contributions. So you don't want to do that. Okay? And it's a little confusing. Again, I think
Sure.
I wrote a FedZone column about that.
That's why we're here, Ed, because this stuff is confusing.
It gets even more confusing when you stop making your contribution to HSA when you retire after age 65. It's in the article. I have some
Gotcha.
examples of that. All right. Number 4, HSA owners may run into penalties if they make HSA withdrawals to pay for qualified medical bills that exceed the amount of the bills. They have a $5,000 bill. They say, I'll take out an extra $7,000 out. Once again, unlike the healthcare FSA custodian, your HSA custodian will do whatever you want. You want $7,000, but the actual amount of your medical bills is $5,000. They'll give you $7,000. So you got an extra $2,000. Oh, I'll take the $2,000 and just put it into my savings account. Well, guess what? IRS is going to make you pay tax on that $2,000 extra you took out and a penalty. You have to do it. You cannot take more money out of your. You can't take more money out of your HSA than actually you're going to be using to pay for qualified medical, dental, vision expenses. That's very important. You've got to keep that in mind. That's, by the way, that's unlike the healthcare FSA, in which if you have a healthcare FSA, let's say it's January, every pay date you're putting money in, but it's early in the leave year. You only got $500 in your healthcare FSA, and then you find out that your child needs orthodontics, and it's going to cost $3,000. Well, you can ask from your healthcare FSA administrator for an advance of $3,000, and they'll give it to you. As long as you got proof that it's what it's for. You got a letter from the orthodontist that costs $3,000. They'll advance the money to you, and then subsequently, in the course of the year, if you pay with donations, they will get the money back because a certain amount of money is coming out each pay date. Eventually, it'll be $3,000. They'll be reimbursed for the money they advance to you. But that's not what it takes with the HSA.
Gotcha. Well, brother, you did it again. Another awesome article on a subject that just doesn't get covered enough. That's what's so special, folks. Share this with your friends. Let them know that Serving This to Serve exists. There's all this free content there, that you can come in the middle of the night, look stuff up. The answers will be there. You can submit questions. You can come to our webinars. You can ask questions live. Ed has really and truly embodied and lived out his life mission to make sure the feds have what they need to know to make the best decisions possible. So, Ed, as I say all the time, I'm going to say it again. On behalf of all feds, thank you for being such a great resource.
My pleasure. It's always a pleasure helping the federal workforce and retirees both. We're here to help. As they say, Dan, you got lots of information out there on the website here. This podcast or other podcasts are done. Their blogs, the FedZone, everything. We are here. We have a mission here. We're trying to make sure that all federal employees and retirees get those questions answered, which is getting to be more of a challenge these days because there are not that many, many of the organizations are underfunded, they're undermanned, whatever.
Yep.
We're trying to fill in those gaps.
Yep. And folks, the big thing to keep in mind is you're not going to go through this alone, no matter what's coming down the pike. Okay. Whatever any administration now or in the future decides to do, we're going to be here walking with you. So bookmark these pages, come back and see us. We're going to be here to help. So that is a wrap. We are Serving This to Serve. So be sure to subscribe to this podcast on our YouTube channel and Spotify. And remember, share it with your friends, strangers, and it's holiday season. Yeah. Extend an olive branch, share it with an enemy. You may make a new friend out of it. And do not forget, as Ed touched on it, do not forget our live webinars every single month. We cover everything in there, even the stuff that most people don't even consider. We've got the big stuff. We got the small stuff. We've got everything. And the big thing is the guru is there. He will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share it with your friends. They will thank you. So be sure to read Ed every single week in the FedZone. That's fed-zone.com. Tons and tons and tons of Ed in there. It's all searchable. Just kick in the topic. You're going to find some Ed that covers it. So closing it out for Ed, the crew at Serving This to Serve, and me, Dan Sipe, I'm going to close as I always do by saying good luck, Godspeed, and above all, remember, it is your FedLife. So make it a great one because you deserve it. Stay well, everybody. We are out.